Welcome back to Investing Talk Podcast. A lot of you have been asking about NRG energy lately, sending in reports and wanting to know is now, a good time to buy. So today we're going to really get into it. We'll look at the latest financials, the market signals, their big strategic moves, basically give you a clear picture. NRG energy is in a fascinating spot, I think, kind of straddling that line between traditional power generation and, well, the huge energy needs of new tech like AI and smart homes. How they manage that tension. That feels like the real story here. So let's explore it. And hey, as always, if you find this useful, please do subscribe, like, comment. It really helps. Oh, and if there's another company you want us to tackle, just drop it in the comments below. Okay, let's start with the basics. For anyone maybe not deep in the energy world, what exactly is NRG energy? What do they do?
Yeah, that's a good place to start. What's interesting about NRG is they're not just one thing. They're a major player in both retail electricity, selling power directly to people like you and me, and also wholesale power generation. So they're making the power and selling it. It covers a whole chain, really.
Right, integrated.
Exactly. And that scale gives them some advantages, in managing prices, hedging risks. But it's a double-edged sword. It also means they're exposed to a lot more volatility operations, regulations. It's complex. And that's really key context for figuring out if it's a buy right now.
Got it. Playing on both sides. Okay, let's get into the numbers then, because Q2 of fiscal 25, well, it looked a bit mixed, didn't it? Revenue for the quarter ending June 25 was up 1% year over year, about $6.74 billion. And for the first half of the year, revenue climbed 9% to $15.33 billion. So sounds pretty strong, right?
On the surface, yeah, top-line growth looks decent.
But then you look at operating income. Oof, it basically broke even in Q2. Compare that to $1.41 billion the year before. And for the first 6 months, operating income dropped 50%. 50 down to $1.13 billion. So what's going on? Where's that margin compression coming from? It looks like growth, but not profitable growth, at least right now.
You've hit the nail on the head. That's the big question. Profitability versus just growing the top line. The main issue here is costs. Their cost of operations shot up 30%. 30%. Reached $5.63 billion just in Q2.
Wow.
Yeah. And on top of that, you've got higher SG&A selling, general admin costs, plus these integration costs. Specifically, they flagged $43 million in Q2, just related to that pending Ellis Power gas asset acquisition they're working on.
Ah, okay. So the acquisition's already hitting the books.
Exactly. So this cost volatility plus the drag from integrating that new business, it's making them cautious. They didn't even give explicit official full-year guidance for 25 in their Q2 10Q filing, which suggests there's definitely some near-term earnings risk they're seeing.
Okay, that's the GAAP picture, the standard accounting view. But I also saw they reported a GAAP net loss of $104 million for Q2, which sounds bad. Yet in the same breath, they're highlighting strong adjusted EBITDA, $909 million, and adjusted EPS of 1.73. They even reaffirmed their full-year guidance at the upper end based on those adjusted numbers. So how do we square that circle? What do these different numbers really tell an investor?
That is such a crucial question. It really gets to how companies frame their performance, doesn't it? If you connect it to the bigger picture, these non-GAAP metrics like adjusted EBITDA or adjusted EPS, they're designed to give a clearer view of the operational performance. They usually strip out things like one-time charges, say those big acquisition costs or non-cash items, things not part of the core day-to-day business.
Okay, so it's like, here's how the underlying business is doing if you ignore these temporary hits.
Pretty much. So while that GAAP net loss shows the full impact of everything, including the integration pains, a stronger adjusted EBITDA suggests the core operations are still churning out a good amount of cash flow. But the trick for an investor is understanding what's being left out and why. Relying too much on adjusted numbers can sometimes mask the full financial reality. And that tension, that difference between the GAAP loss and the adjusted strength, that's exactly why analysts are kind of mixed to cautious right now. There's underlying strength, yes, but also very real short-term headwinds dragging down the official numbers.
That makes sense. You got to look at both. Okay, now this is where I think it gets really interesting. NRG hasn't just been sitting back. They're making some pretty big strategic bets, right? Trying to position themselves for the future. Can you walk us through some of those key moves?
Absolutely. They are definitely active. The biggest headline is probably the pending Ellis Power gas asset acquisition we mentioned. The goal there is clear. Expand generation capacity, grab more regional market share. It's a traditional growth play.
But brings those integration headaches we talked about.
Yes, exactly. Risk and reward. But beyond M&A, they're investing heavily in infrastructure. and with specific focus.
Hey.
They got $216 million from the Texas Energy Fund to expand their T.H. Wharton power plant. That's adding 2 new natural gas units, about 456 megawatts.
Wow, that's a lot of power.
It is. And it's largely to meet growing Texas demand, especially, and this is key, from the AI and data center boom. Those things are just incredibly power hungry. NRG wants to be the one supplying that power. They're also looking at similar projects for their Cedar Bayou and Greens Bayou sites.
So leaning into the AI revolution makes sense from a demand perspective.
Definitely. And they've already signed more power agreements specifically for data centers, another 295 megawatts, with potential to expand that up to a full gigawatt.
A gigawatt, just for data centers.
Potentially, yeah. It really shows how they're positioning themselves to support that AI-driven growth.
Okay, so big bets on gas generation, fueled by AI demand. What about the other side? The retail side, smart homes, renewables, anything happening there?
Good question. They are balancing it somewhat. On the residential side, they've really upped their target for their virtual power plant program in Texas. Went from 20 megawatts to 150 megawatts. That's where homes with, say, solar panels or batteries can feed power back to the grid. It's about distributed energy.
Smart grid stuff.
Exactly. And to drive that, they brought in a new president for NRG Consumer, Brad Bentley, back in July. His focus is on innovation in their smart home businesses. They're targeting over 8 million customers across North America.
So they are trying to play in that future tech space on the consumer side, too.
They are. It's that tension again, right?
Yeah.
Big traditional gas plants for massive industrial data center load, but also pushing into smarter, more distributed residential tech. Oh, and one other thing worth noting, maybe not strategic growth, but brand-related. They committed $500,000 for flood relief in Central Texas. Helps build goodwill, which is important for a utility.
Okay, so they're juggling a lot. Massive projects, acquisitions, consumer tech. Does the company have the financial muscle to actually pull all this off? How healthy are they? Especially looking at debt and liquidity, that's often where ambitious plans can stumble.
Yeah, that's a crucial point. Can they afford these bets? Their liquidity, meaning their access to cash, looks pretty solid. That's a positive. They have a big $4.6 billion revolving credit facility. Think of it like a giant corporate credit card that runs until 2029. Gives them flexibility.
That safety net.
Pretty much. Plus a $2.3 billion receivables facility until 2026, letting them borrow against money customers owe them. So, access to cash seems okay. Now, debt itself. They paid about $148 million in interest in Q2. They also had a small $10 million loss from paying off some debt early, and they redeemed about $232 million of some convertible notes in early July.
So they are managing their debt load.
They are. And the credit lines seem big enough to cover the payments. But here's the catch. Cash generation has tightened up. Why? Because those operating margins are getting squeezed by the transaction costs, the integration efforts, plus just general energy market volatility. So while they can borrow, the cash flow from the actual business is a bit tighter right now.
Okay, access to funds is there, but the internal engine is running a bit lean. Got it. So given all these moving parts, the acquisition, the big investments, the squeezed margins, what are the key risks investors really need to keep front and center? Both NRG-specific stuff and just broader market worries.
This is critical, absolutely. For NRG specifically, the biggest one is probably execution risk on that LS Power integration. Merging big companies smoothly, it's always tough. A stumble there could really hurt.
Yeah, we've seen that happen before with big deals.
Definitely. Then there's the ongoing margin pressure from energy and fuel costs because you get that under control. And their debt load, while manageable now, becomes a bigger risk if cash flow doesn't pick back up.
Makes sense. What about the bigger picture, sector risks?
Well, the energy sector always has commodity price risk. Natural gas and power prices can swing wildly, as we know.
Yeah.
That directly impacts NRG. Weather is another huge one. Think hurricanes hitting generation assets or extreme heat waves like in Texas stressing the grid and spiking prices. Those events create operational chaos and regulatory headaches.
Right. Unpredictable, but potentially massive impacts.
Exactly. And finally, regulatory changes. New environmental rules, shifts in electricity market design, policy changes can totally reshape their business landscape. These are things largely outside their control.
A lot to watch out for. Okay, let's pivot to the market itself. What are the charts telling us? How has NRG's stock actually been behaving recently? What do the technical indicators suggest?
All right, looking at the technicals.
Yeah.
As of September 11th, the stock closed around $158. It's been trading mostly between $150 and $162 recently. Pretty tight range.
So kind of stuck in neutral.
It seems that way. Key short-term support, where buyers tend to show up, looks to be around that $150 mark. Resistance, where sellers step in, is probably closer to $162, maybe $165. Momentum-wise, the 50-day moving average is around the mid-$155. It's pretty flat, suggesting that sideways trend.
Okay.
The longer-term 200-day moving average is down in the low 140s, which is acting as a sort of floor, providing support further down. Now, the RSI, the Relative Strength Index, it's hovering right around the middle, 48 to 52. That's neutral territory, not overbought, not oversold.
No strong signal there either.
Not really.
Yeah.
And the Masquidi indicator, which looks at momentum shifts, is showing some mild bearishness, probably feeling the pressure from that earnings news and the integration cost worries and volatility. Yeah, it's been higher lately, mostly tied to the uncertainty around the LS Power deal and just general swings in the energy sector.
So technicals paint a picture of, well, uncertainty, sideways movement, neutral momentum, higher volatility. Matches the fundamental story, really. What about insiders? Are executives putting their money where their mouth is, buying or selling? And what are the big institutional investors doing?
Yeah, the insider activity is, you guessed it, mixed.
Ha! Figures.
On September 10th, the EVP and CTO, Liani Arapidak, sold about 10,600 shares around $155. But this was reported under a 10b5-1 plan.
Which means it was pre-scheduled, right? Not necessarily a reaction to current events.
Exactly. It's often seen as just portfolio diversification, less of a negative signal. But then, countering that, a director, Alexander Porbet, bought 7,000 shares back on August 25th, around $145.
Director buys are usually seen as more bullish, aren't they?
Generally, yes. It suggests some conviction from the board level. Overall, though, the volume of insider selling is pretty small compared to the total shares out there.
Okay. And the big funds. Goldman, Franklin Resources.
Filings from August showed some ownership changes, but nothing dramatic pointing one way or the other. No mass exodus or sudden rush-in. And analyst ratings, mostly reflecting that mixed to cautious view we've talked about, largely due to the earnings and acquisition costs. So overall market sentiment, pretty neutral, weighed down by the M&A uncertainty and sector volatility. No strong buzz right now.
It really is a story of competing forces. Okay, looking forward then. For people watching NRG closely, what are the key milestones or potential catalysts coming up, short-term and long-term?
Definitely things to keep on the radar.
Yeah.
Short-term, the big one is the Q3 earnings report, expected around October 7th. That'll give us the next update on costs and cash flow.
Crucial update.
Very. Also, watch for institutional filings around September 30th. See if the big players made any moves in Q3. An ETF rebalancing around mid-November can sometimes move stocks. There's also a holiday residential demand report due November 20th, gives a peek into the consumer side. And an AI data center update expected around December 5th. That could be interesting.
Yeah, seeing if those deals are progressing.
And of course, any news on the timing or closure of that LS Power deal. That remains a wild card. Any definitive update could cause ripples, long term. It's really all about successfully integrating LS Power. Can they realize those synergies? Can margins improve once the dust settles? That's the billion-dollar question.
And the broader environment, too, I guess.
Absolutely. Regulations on carbon, interest rate changes impacting their debt. Those long-term trends will be critical.
Okay, those are the knowns, or the expected knowns. What about the unknowns? Any rumors or speculative chatter out there that could potentially move the needle?
Well, there's always chatter in this space, right?
Always.
One bit of speculation is that they might announce more data center deals sooner rather than later, maybe before year-end, given how hot that AI demand is. There are also whispers, purely speculative, that regulators might fast-track the LS Power approval, maybe move that targeted Q1 26 closing up a bit. That would likely be seen positively.
Faster certainty, yeah.
Some analysts are also kicking around the idea of a dividend boost or a special payout. If that strong adjusted EBITDA translates into real excess cash, maybe they'll reward shareholders to boost sentiment.
Interesting possibility.
And finally, persistent rumors that NRG might be looking for more deals, but maybe smaller bolt-on acquisitions, perhaps targeting smart home tech companies or even some renewable assets to balance out the portfolio. An announcement there could shift the narrative.
Lots of potential developments then. Okay, let's try and wrap this all up. We've gone through the financials, the strategy, the risks, the market view. Pulling it all together, our overall investment thesis gives NRG Energy a rating of, let's say, 6 out of 10. Positives. They've got strong liquidity, a big asset base, and there is potential for margins to improve once that LS Power integration is done. And that director buy does signal some confidence, but the negatives are significant right now. Those near-term acquisition costs are real, margins are squeezed, the earnings recovery path is uncertain, and the whole sector is volatile. Plus, that insider sale, even if routine, combined with lukewarm analyst views, it just reinforces a sense of caution, doesn't it?
I think that's fair. For short-term trading, it doesn't look particularly attractive right now. The volatility from the integration, the sector swings, the lack of clear momentum, it just feels risky for a quick trade. Right. But for a longer-term investment, it's arguably reasonable. For patient investors who want exposure to the energy sector and believe NRG can execute the integration and capture those synergies eventually, it could make sense. But, and it's a big but, the risk profile is definitely moderate to high until that LS Power integration is proven out and the earnings picture stabilizes. You need patience, and you need to accept that uncertainty.
Right. It's a wait and see on the execution to some extent. So here's the final thought to leave you with. NRG is living this dual life, right? Traditional power provider, but also pushing hard into high growth AI support and smart home tech. How well they manage that tension, balancing the old infrastructure needs with these future-focused bets, how might that ability or inability ultimately define their long-term value in this energy transition? Something to think about. Thanks for joining us on Investing Talk Podcast. We hope this exploration of NRG Energy gives you some valuable perspective for your own decisions. Catch you next time.